Lovely. Good morning, everyone. Welcome to Innovate Finance's half-year webinar on capital and investment into Fintech. I'm Mike Carter, Senior Policy Advisor at Innovate Finance. I know people are still just joining in, so we'll just get started with some introductions and then we'll get on to our discussion. We've got a great panel here today covering all parts of the capital market spectrum, which is what we try to do so that we can investigate what has been going on across the market for fintechs in the last 6 months. Let's kick off with some introductions from the panel that we have here today. First of all, Kevin, give us a background.
Yeah, thanks, Mike. Good morning, everyone. My name is Kevin Chong. I'm a general partner at Outward VC. We're a London-based early stage venture capital investor in fintech and connected areas. We currently have 35 companies in our portfolio. We're now investing out of a new fund where we expect to be making a new investment every 7 or 8 weeks for the next 2 years. And we focus on people raising anywhere from $500,000 to $5 million funding rounds.
Great. Thank you, Kevin. Anna.
Hello, everyone. Lovely to join you all today. So I'm Anna Nishnidze. I'm the Director of Trade Investment at the City of London Corporation. So the work of my team is very much covers how we improve investment landscape in the UK. A lot of work internationally, so looking at how we attract and bring in more international investment and capital into the UK, but also importantly domestically, looking at how we unlock more capital deployment across the UK. And some of the initiatives that you would have seen the corporation involved in are things like the Mansion House Accord, the Mansion House Compact, and more later evolution of Accord into Sterling 20. So they're all of the things that I'd be happy to talk about today and kind of how we're seeing the capital landscape evolve. Thank you.
Great. Thank you, Anna. Gautam.
Morning, everyone, and thanks, Mike and Innovate Finance, for having me. I'm Gautam Pillai. I head fintech research at Peel Hunt. I spent nearly 20 years covering financial services and technology, including over a decade at Goldman Sachs before joining Peel Hunt. Peel Hunt is a boutique UK investment bank. We work closely with companies, growth companies, investors, and issuers across both public and private markets, giving us a front row seat on IPO activity, capital raising, and investor sentiment. My perspective today reflects both the conversations we're having with investors and discussions we're having with companies that are actively considering a private raise or accessing the public markets over the near term. Thank you.
Great. Thanks, Gautam. Neil.
Thanks very much, Mike. Good morning, everyone. My name's Neil Shah, and I head up coverage of the technology sector for the London Stock Exchange, and we're active across public and private fundraising. Great to meet you all.
Great, Neil. Thank you. And Joshita.
Thank you, Mike. Hello, everyone. I'm Joshita, manager at Innovate Finance. Work with Mike very closely on producing this report. So it's nice to meet all of you today.
Thanks very much. Welcome to the panel. Welcome to all of our guests. Later today, we're going to be publishing our half-year report, which is we're going to be discussing some of the issues arising from that on this webinar. To give everyone a bit of background, Joshita is going to run us through the high-level numbers. She's going to pop some slides up and just tell us what is in the report that's coming out later today. Joshita.
Yes, thank you, Mike. Let me just get that up on the screen. Can you all see my screen?
Yep.
Great, amazing. So as Mike mentioned, I'm going to quickly walk you through our key findings of the half-yearly 2026 report. I am not able to move to the next slide. Yeah, that. So I'm going to quickly run through the headlines, the top deals, and also rankings in terms of countries for fintech and AI investment. So the key headlines of the report: global fintech investment in half-yearly 2026 total to 28 billion across 1,411 deals, which was down 12% from 32.5 billion in the second half of 2025. And UK's funding declined by 5% to 1.8 billion from 1.9 billion at the second half of 2025, maintaining its position as the second largest fintech market globally, behind the US and ahead of India. The UK also remained the largest fintech market in Europe, although the gap with the rest of the Europe continues to narrow. The US decreased investment to 17.2 billion, while AI continued to dominate investment globally. The UK remained the third largest AI investment market, behind the United States and China. Capital markets also welcomed the first headline Pisces transaction, with Wave completing an 85 million employee stock secondary deal. Next slide. In terms of the global top 10, the UK recorded 1.8 billion in fintech investment, as I mentioned earlier, down 5% from the second half of 2025, which is also up 5% compared to the first half, so remaining the largest fintech market in Europe. But the US remains on the top with 17.2 billion, with over 1,076 deals. The rest of the Europe attracted 3.2 billion, up 23% from 2.6 billion in the second half of 2025. Meanwhile, the investment across the rest of the world also declined to 6.3 billion, down 49% from 12.4 billion in the second half of 2025. In terms of rankings, of course, the US first, the United Kingdom second, India, followed by France, Singapore, Mexico, Canada, UAE, Germany, and Brazil. Moving on to the top 5 deals we've seen globally was first up with Ramp in the US, which raised 750 million, followed by Allen in France, raising 554.5 million. Cred in India also raised 500 million. Plata in Mexico with 405 million, and Westwell in the United States with 385 million. So these were the 5 largest fintech founding rounds globally during the first half of 2025. In terms of the European ranking, the UK recorded a 1.8 billion, as mentioned earlier. France followed with 1.3 billion, including funding rounds for Allen, Penny Lane, and Morpho, which were the biggest deals in France. So they've done really well. Germany ranked third with 300 billion across 35 deals. Spain, Switzerland, and Italy each recorded between 200 million and 300 million, while the Netherlands, Ireland, Belgium, and Denmark also around 100 million. So overall, the capital remained concentrated in the UK and France, with France maintaining a very narrow gap behind the UK. So now coming back to home, the largest UK fintech funding round was eBury, who raised 203 million, followed by Paymentology with 175, and Behaviorx 175 million, and 9fin and Elliptic as well raised money in the first quarter. So this is the first time we've analyzed investment in AI, given its importance to the market and its relevance to fintech. So we've highlighted that the current focus on AI globally is diverting attention and capital away from all the other sectors, including fintech. But as shown, UK fintech continues to hold its own in the global rankings and is maintaining investment levels, even if not increasing volumes yet. So additionally, the UK is the third largest market globally for AI investment, behind only the United States and the uncontested leader, and China in second place, well ahead of France and Germany in Europe. So during the first half of 2025, around 14 billion was invested into UK AI and AI-related companies, including Nscale, Wave, and Kraken Technologies. Fintech continues to be a significant adopter of AI technologies, with investment activity across both sectors continuing in parallel. A big shout out to all our members who raised capital in the first half of 2026. Airwallex, Salika Bank, Stream, and all the other members, congratulations. And now I think that is the quick highlights. I hope you get to read the report when you have time, and I pass it on to Mike. Thank you very much.
Thank you, Jasita. So those are the headlines from the report. They're coming out later today. You'll find that on our our website. There's quite a few things coming up in there which we're going to discuss with our panelists. I'll say now we're not claiming Wave as a fintech, but we're very excited about Wave because of the Pisces market opening up. So that is why we're going to be talking about that. We're also going to talk about the whole impact of AI in the market. So let's kick off on the VC market, the core of fintech when companies start out and grow. We heard in the numbers there it's down a little bit in the first half of this year. We've been waiting to see whether there would start to be an upturn in the UK. It's not quite there yet. Kevin, tell us what you've been seeing in the first half of the year in terms of demand for capital in the UK.
Yeah, thanks, Mike. A couple of sort of my own observations on the numbers. I think firstly, I think if we are going to be comparing the sort of various ecosystems around Europe and elsewhere, that the thing that I always look for is the deal count. For me, the deal count is more important than the actual absolute numbers, right? Because I think it's a sign of a healthy ecosystem if more deals are getting done. And I think every year when these numbers come out, it always is the case that you need to sort of look a few layers down to see, for example, what the concentration is, and what sort of things are getting funded. But I do like the fact that if you're sort of comparing us with, say, like France, where whilst the absolute investment number looks roughly the same, the UK deal count is much, much higher. I think that's great. The other thing is that there's obviously a lot of talk right now about sort of AI displacing fintech as an investment category. And I think that's something we've got to be careful about. I don't think you're comparing apples with apples when you look at that sort of differential, because at the end of the day, AI is a technology that will be applied across a range of industries, and no doubt financial services will be one of, if not the most important sector for AI technology. And I think we're going to see a lot of transformation in financial services coming out of these AI investments. And I would certainly argue for it to be included in the fintech numbers. And that's certainly the case for an early stage investor like us. We have traditionally been very focused on fintech, but more recently, a lot of our investments have been in broader AI technology, where the application is the bulk of the application will be in financial services. I'm happy to give a couple of examples to
Please do, yeah,
to illustrate what I'm saying. So, we recently invested in Cosign, which people may have read about. They're building a sovereign AI model, and working with some design partners in sort of critical UK sectors. So in financial services, the sort of design partners for this sovereign AI model, people like HSBC, Lloyds, NatWest, London Stock Exchange as well, actually, signed up to be design partners for Cosign. And this is, what they're addressing there is the issue of being over reliant on foreign infrastructure when it comes to AI. When you're a critical sector and you've got to make sure that your code, your data, it stays within sort of a controlled boundary. And the problem with AI right now is that you can't actually do that. So that's where sort of Cosign comes in, and so we're sort of very excited to be backing them, because we do think that this is the direction of travel when it comes to deploying AI into critical regulated sectors, and banks and other financial services is a key part of that. So that's one example. Another example is we recently, and this one hasn't been announced yet, we invested in a research-based startup that's looking to solve the issue of security around AI agents. And that's something which I'm sure every bank, payments company, financial services, etc., looking at sort of deploying agents. But there isn't really a proper workable security solution around it currently. So we invested in this startup that's looking to solve issue of security at a sort of most basic level, sort of kernel level security within the operating system, so that you can detect when an agent is doing something and what it might be doing. So just two examples of things which I think conventionally wouldn't be categorized as fintech, but will have tremendous implications for the financial services sector. So, I mean, two of my sort of broad observations, I think, on the numbers.
Thanks, Kevin. And are you finding that companies, when they are looking for capital, are trying to squeeze themselves into the AI bucket in order because they feel they need to do that for funding?
Yeah, that there is quite a lot of that. It's a little bit unfortunate, really. I don't think it. I mean, anyone who's listening and raising their sort of pre-seed or seed round, should know that gets it isn't the best way necessarily to raise VC funding. Just to add a sort of like a .ai to your URL. Because it's all, at the end of the day, it's all about sort of what is the application, and are you solving a real problem?
I mean, Gautam, for the companies that you meet and cover, I mean, how are you finding they are presenting their AI capabilities?
Thanks, Mike. I think see, it is a very interesting question, and the market, we before you had kind of asked me the question whether adding a name to AI to the company's name is enough, and we see a lot of those such companies in the market right now. The short answer is no. Adding AI to the name or putting AI in a slide deck is not enough, and investors will absolutely see through it. And the market's simplistic fear right now, and people on the call may have heard of this term SaaSocalypse, where a lot of SaaS companies globally has been severely derated because of the worry that AI will take the business away. And the simple fear is that AI writes code is software, therefore software is dead. I don't think that is correct. AI does come out as coding, but not B2B software, because the value sits in the workflow embeddedness, regulatory encoding, institutional trust, and years of domain logic. So to answer your question, Mike, the companies who I see, the way they are thinking about it, and specifically from a fintech standpoint, fintechs usually operate in a regulated financial service environment. The moat is rarely just the user interface. It is compliance, data, distribution, trust, risk models, licenses, workflows, and customer adoption. So AI can enhance those assets, but it does not automatically replace them. So the right question is, who captures the AI value? If an AI agent sits on top of a fintech product, does the fintech capture the uplift through pricing, retention, and product expansion? Or does the value leak away to the customer, the hyperscaler, or the foundation model provider? These are the kind of questions which the companies who I deal with are trying to answer. So it is not just kind of, oh yeah, I use AI to kind of draft an email. That is not what these kind of companies are trying to do. And AI is no longer enough as a narrative. Yes, we use AI in our organization. That is not enough. It has to show up in metrics.
Yeah, thank you. And Kevin, Gautam mentioned the SaaScopolis, which had a lot of coverage. What's the view from the VC office?
Look, clearly, we're now in a world where you can build something a lot faster with a lot less resources, right? But that doesn't mean, though, that just because you can build something fast, that it works, it's secure enough, it can be audited, or that you can even be able, in a way that would work in a sort of large financial services organization, right, which is regulated, and where there is a lot of compliance hurdles to get through. So I think there will be like a lot of opportunities for people to for startups to provide another layer of support to this sort of idea of like being able to like code faster, but that it, but it's only part of the process. So I mean, we're definitely right now looking at a number of startups that we're about to invest in, that will sort of provide another that decision making layer, when it comes to being able to code faster, and and what that layer will do is allow like a large financial service organization to benchmark what they say what they're doing against others in their peer group. It will allow them to provide data that can be audited, around sort of how the decisions were made to generate the code. So I think like with any new technology, there are a lot of sort of implications that we're not yet aware of, that we haven't sort of fully understood. And it will be, whilst it might be fine if you're a small, medium-sized organization, it's very different when you're a large sort of regulated bank or financial services player.
Yeah. Okay, thank you. And tell me, investment over the last 3 or 4 half years has been fairly flat. It's sort of up or down 5% in the UK in fintech. When I talk to members and I look at their results, they're all still growing rapidly, 30, 40, 50% per annum. Many of the larger members are past break even and generating large profits. So my impression is the sector is doing what it said it would do in terms of growth and value creation, but there doesn't seem to be a huge amount of extra money coming in, from a capital perspective. What do you think is holding that back?
Look, I guess, as I said earlier on, I think we have to be a little bit careful about sort of jumping straight to the conclusion that fintech is receiving less support from the investment community. It's true that a lot of the money is now going towards AI technologies, but as I was saying before, those things will transform financial services and really ought to be have a sort of secondary label of fintech in itself. And so for us as an investor, I mean, it's sort of like Galton was saying just now, it's about selecting companies that we think will have a real impact on a sector like the financial services sector, but in a sort of truly transformational way. So we're looking for people that are building something where there is some proprietary data, say, that they're bringing to the table, or doing something to enable a bank or sort of regulated insurer to deploy AI into their environment. Because right now you find that actually there's AI sounds like a very, obviously everyone's very keen on the power of AI, but actually for most sort of a lot of people in the sort of regulated financial service sector are not yet able to even deploy the AI into their environment, because of sort of security concerns and sort of and sovereign concerns.
Yeah. No, thank you. So moving further along the capital spectrum, we've been talking on our webinars and at our events for the last few years about an upcoming new market called Pisces, which is designed to provide liquidity for companies when they get larger, but not before they're listed. And Neil, you and I have been talking about this every time we have one of these, and we've been saying it's coming soon. It's coming soon. Well, now it's actually launched, and we've seen
real.
some deals. So we're very excited to have you here this morning. to tell us about that. So, first of all, just remind everyone what Pisces is and just where it's come from.
Absolutely, Mike. Hi, everyone. So Pisces is the world's first private intermittent securities and capital exchange system, the world's first regulated crossover market where companies can show up and essentially go public for a day and then go back to being private again. And the beauty of this platform is that it's hugely flexible. So when we had our first transaction for Oxford Science Enterprises, a deep tech fund in March, they literally showed up and they asked the likes of Peel Hunt and Gotham's team, Crowdcube and others to say, we've got this much stock to sell, go and find us the buyers on the day of the auction. And that's exactly what Pisces was able to do. We had a fantastic transaction for Wave yesterday that placed $85 million of stock on behalf of, I think, something like 500 employees spread around the globe yesterday. So it's fantastic that those employees have perhaps been waiting for liquidity, been able to realize that before an exit event, which is typically an M&A sale or an IPO, and hopefully other companies will be able to utilize this as well. So that's the essence of the platform. There's a few of these around. I think there's some unique aspects of this that makes it particularly attractive for companies with employees in EMI and CSOP schemes in the UK. It's repeatable and really designed to take friction out of the system. Historically, when you do a private placement, you might have to sign 50 sale and purchase agreements with various employees to facilitate their transaction. Here we deal with contract notes and we settle in to Crest, which is a very familiar framework for everyone involved in public markets, and a great way to also clean up the cap table and get ready for hopefully life on public markets at some point, which is something I'm a massive advocate of.
Thanks, Neil. So that I think it's great that we've had this deal from Wade. This has been probably 3 years in the cooking in Pisces, I would guess, Neil, hasn't it? And I would give a lot of congratulations to the LSE for having led the whole development of the Pisces project and the Treasury and the FCA then putting together to create the framework and the rules. So it's been a great collaboration to get here. And I think a lot of our fintech members have been watching this with great interest in terms of, is this going to create a market that will allow secondary liquidity before going public? So it's a quite a milestone. Can you just tell us a little bit more, Neil, about in terms of if a company was to go down this route, so how long is the process? When would they need to start preparing before they could actually go live?
Yeah, I think often people show up and they expect to transact tomorrow. So my advice would be you probably need 2 or 3 months, like any transaction, just to make sure that docs are in order and things are as one might expect. I think companies tend to think that they're perhaps a little bit better prepared than some of their advisors might later find out some of what investors would expect. So give yourself a good 3 months for any transaction at a minimum. But we're here to help, to have conversations. Ultimately, this is a people business, and you need to develop trust. So if you are going out to new investors, you probably want to make sure that they're not hearing about you the first time when you're actually doing a deal. Say hello to them, get to know them beforehand, and that will make things so much smoother. And I think while Pisces can be used for price discovery, but some of the fintechs have been a lot of fundraisers recently with a recent price marker. That's going to be a much more valid price marker than a last raise, which may have been in 2021. So think about that as well. How can you give investors comfort that the current valuation of the company holds water, and what better test than having raised some primary with a new investor recently? And we're partnering with about 20 or so banks. It was Stifel and Crowdcube were involved in the Wave transaction. Gotham's firm, Peel Hunt, Cavendish, Canaccord, and others are involved with the TPE deal. We're also expecting some fintechs to be using the platform in due course. Lots of conversations with your members, Mike, and the Unicorn Council. And look, this is really open to all, including international businesses and international investors.
That's great. So in the second half of this year, we should hope to see some more trades coming through.
Absolutely.
That's great. No, that's very exciting, and congratulations on getting the market up and running. It's a great milestone. So moving now on to other parts of the capital markets, but still not the listed markets. I'd like to turn to Anna to talk about all the good work the City of London have been doing um, around growth capital and scale up capital. Anna, we've also been talking to you and colleagues in the last few years on these webinars and at our events about what was originally the Mansion House Compact, which has gone through a number of evolutions and is moving forward. So I'd love to hear an update from you in terms of where this has got to and what the latest is.
Yes, thanks, Mike. And look, I'm hoping I can inject a bit of positivity into where we're heading and the progress that's been made. And I hope that the audience don't take it as being blindsided by the challenge that still is there and the gap that is still there. And so I'm absolutely not suggesting that we should take our pedal off the accelerator, but I do feel like it's important for us to pause and reflect on what's been achieved. And as you mentioned, we started this journey 3 years ago, a bit more than 3 years ago, with the Mansion House Compact. Last year, we had 17 pension funds, DC pension funds sign Mansion House Accord. The government then afterwards also announced a broader group of sterling 20, and the objective is to look at how can we unlock more deployment of UK pension funds into domestic private markets. And I think what we're seeing 18 months on is that, also 12 months on since the Accord, is that there's actually quite a lot of progress that's been made. I think what the Compact and the Accord and the Sterling 20 have been able to achieve is that they shifted the conversation away from well, actually there's a lack of this and we just don't do it, to actually there's a consensus that that long-term UK productive assets should play a much greater role in pension portfolios. I don't think anyone would argue that. This is the talk of the town. This is the dialogue everywhere you go, including with those pension funds. And so I think there are a couple of things in that space that we should start to celebrate. British Growth Partnership was not established all that long ago, and they didn't close their first round all that long ago. But that was as a kind of first attempt of kind of public-private partnership, almost, with the BBB leading it, and then pension funds coming in to create a vehicle that can start to deliver on some of the ambitions that was set out in the Compact and then the Accord. And so you've got pension funds, you've got Cushion, you've got M&G, you've got Aegon, who are all investing in BBB, and I'm sure more are looking at it as a vehicle. We had an extremely exciting announcement from Nest yesterday, who've announced that they will invest 1 billion into venture capital by 2030, and that's huge. Nest's been one of the leading signatories who we've been engaging with very closely, who's been proactively kind of leading the pack in terms of looking at what new products they could introduce, how could they change some of their risk appetite, some of their structures, some of their and how can they work internally on some of the issues around fee caps, etc., to solve for this challenge. And so they're partnering with Schroders to unlock it. And I think that's a really, really fantastic announcement that we heard from yesterday. But also others, Aviva has been doing a lot of work looking at how they can increase their allocation to private equity infrastructure and private credit, and they've been introducing new products that allow them to start looking at this growth space that we're talking about. So there is absolutely movement in the market, and I think it's important that we acknowledge that. And as part of that movement, we are seeing kind of new generation of investment vehicles achieving, and I think so one of the interesting figures that we've looked at is that there's actually been 11 new LTAFs created in the last 12 months since their courts coming into place. And I think that's pretty significant. I think in total, there are about 42 FCA authorized LTAFs at the moment. And most of those were actually created on the back of the compact, and then their court kind of accelerated some of that in the last 12 months. We are seeing more pension friendly semi-liquid investment products enter the market. We've got Future Growth Capital that launched last year. We are seeing some new venture and growth fund of funds models that are being created. There is that genuine movement that's taking place. I think in saying that, we do all know that there is still a gap. There is still a challenge, particularly when we're talking about Series B and Series C funding, and sort of kind of businesses with values of 50 million to 150 million. There is still a gap there, and it is a gap that we still need to address. We do know that that there's more that the UK pension funds can be doing. Absolutely, we are on a journey, but their allocations are still pretty low. And so there's still a bit more work that needs to be done. So I think what that means is that we're not done yet, and we need to continue to look at, are there existing vehicles on the market that the pension funds could be engaging with? And this is where we see our role at the corporation to help kind of connect some of those pieces, to look at what's already out there and whether that's something that the pension funds can start engaging a bit more to facilitate their deployment. Or if there's not, is there something that we need to introduce into the market? And so, that's the dialogue that we continue to have with the pension funds, but also fund managers, that if we're still looking for a vehicle, if we still don't have a vehicle that really addresses some of the risk appetite capability challenges that some of the pension funds have, how do we do that? How do we go about that? What can we introduce onto the market to help solve that challenge? So I think so absolutely, there's continuous work in progress there. And I do want to give a bit of a shout out to Pisces on that front as well, is that while we're absolutely not saying that Pisces solves the whole problem, and there still needs to be kind of the private fund of fund type vehicles that help with the deployment at scale. I think Pisces platform creates a really interesting avenue and a vehicle for some of the pension funds. And I know there are some groups that are looking at how they can better leverage the Pisces framework to introduce new vehicles under that framework as well, that could help pension funds with allocation. And I think that is also a really nice solution that could be introduced into the mix of things. And then just a final thing that I would say, that another positive that we're seeing is that the international capital flow into UK scale up continues to grow. So what we are seeing is that there's much more and more appetite from players from across Japan, Gulf, Australia, Canada, who are interested in investing in the UK VCs. So, and I guess that's a positive story, because they're not investing into firms directly and then asking them to move to those jurisdictions. They're investing into the UK VCs, so then those VCs can deploy into UK scale ups. And I think that's the trend that we continue to see is growing, and something that we continue to really push for when we travel internationally with the Lady Mayor. That's a big part of our conversations around connecting those kind of international capital providers, whether it's sovereign wealth funds or pension funds or institutional investors, to the UK VCs, to see that capital flow growing. So look, my point would be that there's still work to be done, but actually let's pause and reflect and celebrate where we're at. And we've achieved that in a pretty, I'd appreciate people would say we're not moving fast enough. I would probably say, actually, we started to move pretty fast in the last 12 months, but we have quite a lot of great ground to make up. And that's probably what everyone is feeling, is that we're not where we would want to be. But I actually do think we're starting to move much faster, and there's a lot more progress and traction that's been made.
That's really helpful to hear that, Anna. So it sounds like a lot has been happening in the last 12 months. And some of the pension funds are individually working out their own solutions, but City London are still going to be pushing to try and help all the pension funds find a solution. Is that right?
Absolutely. Yeah. Look, we still see it as a really key priority for us, and Lady Mayor and the policy chairman see that as one of the key areas of focus. So the conversations as pension funds continue, whether it's to go look at the vehicles that are already available and help kind of crowd in into those, or whether if there's still a real gap in the market, then what can we do to help address that gap from a vehicle perspective?
Great. So there'll be more work on this after the summer and through the autumn to try and get more pension funds comfortable with a suitable vehicle.
Yeah, definitely.
Okay. Good also to hear about the international investment, because we focus a lot about the UK pension funds, but we mustn't forget that international investment is important, and we don't want to turn them off. So what you're saying is there's still good interest in the UK from international investors.
Yeah, particularly across sort of the Gulf Asia region. Well, I mean, US, of course, there's always US VCs that are interested in UK firms. So I'm kind of putting that in a slightly different bucket. But I think where we're seeing a lot of appetite is a lot of Gulf sovereign wealth funds are very interested in investing in UK VCs, and a lot of Asian sovereign wealth funds or institutional investors from Japan, Singapore, Indonesia, we're seeing make quite interesting moves into investing into the UK VCs.
Okay, that's great to hear. Well, let's now turn to the listed markets, to the far end of the spectrum. Gotham, the market was up in the first half of this year. It was up last year. We're still not seeing a huge amount of IPO activity though. So what's going on?
Um, I would say the IPO sentiment is improving, but is still selective. The issue in the first half has been timing and market volatility, and confidence issues around valuation. It's not an absence of demand. We have been, and I think Neil can validate this. We are sitting on a pipeline which has been the strongest in a long time. The demand has not disappeared. It means that issuers and advisors are being careful about the IPO windows, pricing, and aftermarket performance. And aftermarket performance super important, given some of the experiences we have had in UK IPOs in the recent past. So in today's market, public market investors are willing to engage, but they want to see quality, valuation discipline, sensible sizing, and proper education. So if somebody wants to do like a rushed process, very hard to kind of execute in this market. And if you think about the public market generally, two issues I would say are the headlines in the market in the first half. One is obviously the geopolitical situation, which is volatile on a week by week or even a day by day basis, which has meant that some of the people who were thinking about coming to the market have paused. The other, not an issue, but the other headline is the whole AI-driven valuation situation. And there is obviously an argument that AI has pushed valuations for certain companies up, and for certain companies down. So volatility is not something which an IPO market likes, and that is probably what kind of limited the number of issuances we saw in the first half. Across ECM, we have seen good participation where the story is clear, the use of proceeds is sensible, and the valuation leaves something on the table. Ticket sizes may be smaller than they were in the last cycle, but good deals will find institutional support, is my view. And as I said before, the days of a narrow marketing process and trust us on valuation approach are gone. Companies need to do a full pre-marketing, address investor concerns early, and be very clear on growth, margins, cash generation, capital allocation. So if there is somebody in the audience thinking about an IPO, I would say engage early with advisors. Go and meet the investors as soon as possible, because and this is a piece of advice I give to a lot of CEOs and founders. When you are sitting across a table doing an IPO marketing, that should not be the first time someone had heard about the company or understand the business model. So engaging early, and it can be as early as possible. There is no specific time limit for that. Is super important.
Thank you. Neil, I think you're on LinkedIn. Neil,
Yes.
you're on LinkedIn yesterday saying biggest pipeline for 20 years or something.
That's right. I get a lot of stick for being too optimistic, but it's better than being miserable, folks. So I'm the opposite of a doomer. I think there's a lot to be hopeful of. And let's put this in the context. We're a nation of about 70 million people. Fundraising this year has been phenomenal in fintech and in AI. We've got a number of companies that are maturing. We've got international fintechs like Lemfi setting up their HQ in London, $200 million of revenue. You've got MoneyPoint here, which is $500 million of revenue. There's fantastic companies to be celebrating. And at some point, these companies will probably turn to public markets, and we're here for them. In this pipeline, there's a couple of really large fintechs that we hope will come to London. We're seeing activity in cyberspace as well and other sectors. There's a healthy amount of tech. And I think Gotham's absolutely right. Valuation discipline matters. If I look at the F Prime FinTech Index, there's probably about 7 companies or so trading north of 10 times revenue. And so, if you are thinking about coming to market, you've got to put yourselves in the shoes of new investors and say, what else could they buy with the same valuation as you, and how do you stack up against those companies? And ultimately, they need to see a bargain to invest. What investors don't want to do is invest in a company for them to trade down like Klarna has from 15 billion IPO. I think it's about halved since launch. eToro, PicPay, Wise has transferred to the States haven't been attractive. And I think for IPOs to work as an asset class, people need to make money. So if you remember that simple lesson, find a way for investors to make money, they'll show up. I had a fantastic call with Octopus Ventures the other day, who can deploy up to 40 million pounds of VC capital in a single deal.
Yes.
So that's just an example of one type of investor that can participate at the AIM end of the market, which has worked beautifully for businesses like Phonics, like Boku. PensionBee joined us with just £6.5 million of revenue. It's 50 million today. The CEO, Romy, has £100 million stake in Woodbury shares.
People will have the same question.
That's a pretty good deal if you ask me. And I think public markets just need better rep.
For projects.
Thank you, Neil. One of your colleagues is on the blower, I think, and is is slightly interfering with the sound coming through your microphone. Gotham, back to you. So, I mean, a lot of the talk around IPOs is often around the unicorns. Neil touched there on smaller companies and AIM. Charles Hall at Peel Hunt has been quite vocal, along with the QCA, talking about some of the liquidity issues around AIM. What's your feeling around liquidity on AIM at the moment for if there's a smaller fintech thinking about listing?
I mean, not going to mince words, but yes, liquidity in AIM is a concern, but for the right company is not the concern. So it's all about whether, and when I say the right company, if there is a company which is growing fast, is generating profits and cash flow, investors will kind of come to those companies. It doesn't matter which index it's listed. I think that's a reality of the situation. And we have had multiple companies. I've worked very closely with a lot of companies which have grown and even taken out from AIM, which is born in the AIM, or rather listed in AIM, grew into the main market, and then got acquired by big US investors. A couple of names I would mention is one is Alpha Group, which was listed in 2017 for 9 million revenues and 4.5 million of profit for a market cap of 67 million, and was taken out in 2025 last year by a US company called Corpay for 1.8 billion pounds. And when it was taken out, they were doing close to 200 million of revenues, and that entire growth has been organic. In that process, we did kind of move them from AIM to main. But what I'm trying to say is that yes, generally for the AIM market, there is a liquidity concern. But if you're the right company, I think investors will find those companies.
Okay, thank you very much. So to finish up, I'd just like us to look forward to the second half of the year and just to get your views on how you think the market's going to play out. Obviously, there's a lot of geopolitical noise. The markets, in many respects, seem to have carried on despite everything that's been going on around the world, and funding has continued, even though there've been a lot of shocks to the system. We can't ignore the fact that in the UK we've got a change of prime minister coming up, which is going to cause some uncertainty. So I'd like to hear from each of you how you think the second half is going to play out in terms of investment into the market. And let me kick off, Kevin, with you from the VC side.
I think as far as early stage VC is concerned, I don't know that there's too much more that can happen in a sort of geopolitical sphere that will have any impact. I think all the crazy stuff that has happened has already been sort of factored in. I guess there's one thing that could affect sort of early stage VC sentiment is if we have some sort of correction in the public markets. Obviously there are some quite sort of, it's a very concentrated market at the moment. So I think that's something to watch out for. But I don't see sort of geopolitics having much of an impact. I think in terms of the UK market, I think it's not helpful that we're about to have another change in the sort of leadership, because I think the investment community always likes a stable environment. So change right now is probably not helpful, but I guess it is what it is.
Okay, great. Thank you. Anna, you're dealing with long-term investors, but looking at doing stuff in the short term to get set up. What's your feeling?
Look, I think I agree with Kevin. Investors look for stability, so the change in leadership is not the best, not the most helpful thing from that perspective. But I think that from a domestic perspective, I think the government will only continue to lean in more on this issue. And we're working very closely with Treasury, who still see this as a major priority, regardless of whether we do have a different leadership from a Chancellor perspective. And we are planning out what we're going to do together over the next coming months post-summer to really push further deployment and really work with pension funds and only further accelerate that work. So I think we will continue to see really good progress in this space domestically. I think internationally, putting these stability challenges aside, I do still think that given everything that's happening in geopolitics globally, UK seemed to be quite a pretty good destination. And so I do think we will continue to see pretty stable flows of international capital into this space. I would just say that what we really need to watch out for, and where we're absolutely leaning in quite heavily in terms of our briefings for any potential new leadership, is we need to have the right settings, not just for capital flowing, but investors wanting to stay, and more importantly, founders and companies wanting to grow and scale their businesses in the UK. And actually think that might be a bigger challenge that we need to be that the government really needs to be mindful of, and absolutely something that I know you guys push for a lot, and we will absolutely continue to push for as well.
Yeah, no, totally agree with that, Anna. We're very much aligned with you on that in terms of making sure that we have the best environment for founders to not just to come here, but to stay here and grow the business. Yeah, no, thank you for that. Neil, this might be a little bit unfair given that we haven't had many Pisces deals and we don't know who the investors were, but any reason why Pisces won't now march on in the second half of the year?
We've got a really strong pipeline. There's good investors looking at these companies. The best companies always attract the best investors, right? And it's been tragic that so far there's been so little UK investment generally in tech. Hence why we're so aligned with Anna and trying to unlock pension fund assets to invest in these companies because they're fantastic companies, and if we don't fund them, someone else will. So it's really ours to lose. So I wish for greater stability, fewer global conflicts. We've survived the World Cup almost, so it's only up from here. And my message to our leadership is probably what everyone wants to say but can't, which is please don't score any more own goals. We've scored quite a few of those, and we just want to go forward from here on.
Thank you. Gotham, maybe the public markets are the most susceptible to the current domestic uncertainty. I don't know. Tell us what you think is going to happen in H2.
Yeah, I think, see, a lot of external factors, and you pointed out a few of that. Definitely a prime minister change, major change. We don't know what the new policies are going to be. Geopolitical issues have not yet settled. The AI related risks are still up in the air. So a lot of external factors. Obviously, while I'm not as optimistic as Neil, I'm also fairly optimistic. I want to believe that the market will come back. Markets are cyclical, and we have had a lull for quite a long time. So it's only a question of It's only a question of when, not if, the markets will rebound. And see, if you look across the pond and look at US. US had blockbuster listings in the first half, and so the opportunity is there for companies to tap into public markets. And for founders in this call, or generally, I would say that worry about things which they can control. There are external factors which you can't control. But what I would say specifically to fintech founders is that investors are willing to back fintech, and payments infrastructure, fraud prevention, financial crime, embedded finance, vertical financial software are all areas of interest where people will back companies. And obviously, the sector is past the growth at all costs phase and is becoming more institutional, more regulated, and more valuation sensitive, which is good for the long-term healthiness of the market. So as long as people can have a more practical view on valuation, the market is open, in my view.
Okay, no, that's very helpful. Thank you very much. Okay, well, look, we're going to wrap it up there. I'm going to say thank you very much to the panel for giving their insights today. There are a lot of issues here that we've been discussing for a few years now that are really starting to move forward, which is great. And we have an event actually on the 8th of October, Fintech as a Force for Good, and I imagine we will have a panel there as well to provide a further update on what has been going on here. So if anybody watching wants to come along to that, you'll find details on our website. That's on the 8th of October. So I will just finish by saying thank you to everyone on the panel for joining us today, and thank you to everybody who has dialed in. The report will be published this afternoon. It'll be on our website, so you can read all the numbers in detail. And the webinar will be on our YouTube channel in a few days' time. Thank you all.
Thank you.
Great. Thanks very much.